Understanding the documents at time of death is important, but you also need to understand how taxes work at time of death in order to successfully preserve your estate. There's 3 major taxes at time of death, and many of us know about 1 or 2 of these taxes, and we come to learn that those taxes don't apply to us, so we get a false sense of security and don't worry about the largest or 3rd tax at time of death. So let's go over these. The first tax at time of death that you might think of is the federal estate tax. This is the tax that goes to the federal government when somebody dies. Now, the good news here is, first, there is no tax between husbands and wives, provided you're both citizens. Now, if you're not both citizens, it's not quite as simple as what I just said, and that might be a reason to reach out to us for some clarification. Now, between husband and wives, there is no tax of any amount. You can give an unlimited amount or pass an unlimited amount at time of death to your surviving spouse, and there is no tax. Now, beyond that, once you start passing assets on to kids and grandkids and other individuals in your life, federal estate tax could possibly become a problem. The good news here, though, is there's an exemption. There's an amount that you're allowed to pass to the next generation before any taxes kick in. Now, the exemption is different for individuals versus married couples. For an individual, the amount that you're allowed to pass to the next generation tax-free as far as federal estate tax goes is, hold on to your hats now, $11,400,000. So at this point you might be thinking, I can turn this video off. I don't need to worry. I'm well below that threshold. But please don't. There's other taxes at time of death that can really explode and blow up the amount of money that you're going to be leaving to the next generation. And I don't mean blow up in a good way, I mean blow up in a bad way. Now, for married couples, the amount of money that can be passed on to the next generation is $22,800,000 to the next generation. So most folks do not have an estate tax problem. But if you do have an estate tax problem, if you're above those thresholds, that's a good problem to have, and we're here to help. Just reach out to us and let us know, and we'll be happy to teach you some additional techniques to help reduce the federal estate tax. That's really beyond the confines of this particular video. The next tax at time of death that you want to be aware of is any type of tax assessed by your state. The states are allowed to tax estates as well. Now, some states call it a state inheritance tax. Pennsylvania, the state that I'm in, calls it an inheritance tax. And every state works a bit differently, so you want to learn how the death taxes work in your state on the state level. The biggest tax at time of death, though, in most estates is actually income tax. And this can be as much as 37%. A lot of folks would say, income tax at time of death? What type of income would I have when I die? And the answer is IRAs and 401ks. Think about it like this. If you were to withdraw everything from your IRAs and 401ks all at once, right away, this year, what would that do to this year's tax return? It would explode, wouldn't it? It could be as high as 37% income tax that's owed on those withdrawals, and that money goes to Uncle Sam and is lost to you and your family. Well, that's exactly what happens at time of death, unless you do some special planning to the contrary. When you die, your IRAs and 401ks get distributed to your beneficiaries as a lump sum and is therefore lump sum taxable at time of death. So income tax really is the biggest tax at time of death for most families. It's absolutely a surprise to the kids as well. They think that this money they're going to receive, they're all going to receive it tax-free, because the will said all taxes and fees to be paid before any distributions are made. But if you remember from a moment ago, the will is not what rules the day here, it's the beneficiary designation. So the beneficiary designation links up with the plan document and says the beneficiary receives a check lump sum, and that check is now taxable lump sum in which the year it is received. Okay, folks, I need to break in here for a moment and share with you there's been some tax law changes effective January 1st, 2020. The Secure Act has changed what it means to protect and shield your assets for the next generation. Under the old system, your kids used to be able to inherit your IRAs as their IRAs and keep the tax deferral going for the rest of their life. Over their lifetime, they would have to make small withdrawals each year based on their life expectancy and only pay taxes on those small life expectancy withdrawals as they occur. But now, 2020 going forward, the Secure Act has changed that, where your kids can now only do a 10-year stretch on the IRA. Now, it's still worth doing even though it's not as good, because think of it like this. Let's say you've got $400,000 in the thrift savings plan through the federal government, or the deferred compensation plan through the state, or maybe it's some type of defined benefit plan through your private employer, or 401k, or a TSA, or any type of pre-tax plan through work. So the beneficiary designation in those plans has everybody getting their money as a lump sum, which means it's taxable all at once as a lump sum. So that $400,000 gets paid out to your kid. Your kid receives that $400,000, and the problem is they think it's all theirs. What if they pay off the house, buy a new car, take the grandkids to Disney World, and maybe save $10,000 for a rainy day? And they've pretty much spent it all. Well, it might become a real shocker when they get a tax bill from the IRS come next April 15th for $148,000. $148,000 is 37%. And if you've got over $400,000 a year in taxable income, which inheriting $400,000 from one of these types of retirement plans is to your kids, well, they're going to be in the top tax bracket of 37%. So that's an unexpected tax bill of $148,000. You think that can cause some problems, cause some heartache, cause some misery? You betcha. The solution is the Stretch IRA. The Stretch IRA allows your kids to inherit your IRA as their IRA and stretch the taxes out over 10 years' time. That's why they call it the Stretch IRA. Now that means your child would have to report $40,000 a year each year over the next 10 years as income and pay the income tax on that. Now, adding $40,000 of income to a family and having to pay income tax on that is not a big deal. But adding $400,000 of income to a family in just 1 year is a big deal. So maybe just adding this $40,000 a year to income, if they didn't have any other income, they would only be in the 10% tax bracket. So maybe it's as low as 10%. So the unexpected tax bill would only be $4,000 in this example, not $148,000 of the lump sum distribution. Now at this point, some folks might say, well, yeah, Matt, but don't they have to do that every year over the next 10 years? And the answer is yes. They would have to withdraw roughly 10% of the account each year over the next 10 years and report that as income and pay income tax on that. But think about it like this. Would you rather pay $4,000 10 times to the IRS or $148,000 one time? Now, for those of you who are bad at math, it's a lot cheaper to pay $40,000 over 10 years than $148,000 all at once. Now, at this point, some folks will say to me, well, yeah, Matt, but I'd really like to help my kids just get those taxes out of the way. Pay the taxes and they'll invest the difference and they'll have it grow. So I'll say, well, okay, let's run the numbers on that. So your child inherits $400,000 from you. They pay the $148,000 tax bill. They've now got $252,000 of money to invest. And let's say they invest that $252,000 and they earn a 5%. And let's say they're in a very low tax bracket. Let's say they're only in the 10% tax bracket. Over 10 years' time, that $252,000 would actually grow to about $391,348. So it grows, but it's not even back up to the gross amount that they received in their inheritance. It's not the $400,000 that we started with. Now the stretch IRA is a lot different because the kids are going to probably invest that and leave that invested as well. So you have an extra 10 years of tax deferral on the IRA side, and the post-tax money can be invested and grow as well. So when you figure over time, you're making withdrawals and paying taxes at a lower rate, but it's all growing during the process, the stretch IRA at the end of the 10-year mark, after it's all been paid out and all the taxes have been paid, ends up being about $637,772. That's right. It's about $246,423 more, which is about 63%. So your kids will inherit 63% more money if you do the stretch IRA versus if you simply leave your money in your employer's plan. You do not want to do that. As soon as you're able, you want to do the rollover to a stretch IRA. It will not hurt you in any capacity. It will not raise your taxes. It will not raise your fees. It will not give your kids ownership or access to your accounts during your lifetime either. It will not take away any investment choices. You can still choose from any investment you have. You could probably still have that exact same investment as your stretch IRA. So why wouldn't you? It's one of the few things in the world of finance that I can think of where there's literally no trade-off. There's only reasons to do the stretch IRA, no reasons not to. So if you'd like to be remembered for having passed on, well, 63% more without a large unexpected tax bill, you really want to look at implementing the stretch IRA, and that's certainly something we can help you with here. Just give us a call.